Hello, hi, good day, guys. How are you today? Wish you all in the good health and spirit. And today we would like to talk about fair value measurement, an important concept in accounting, as especially when we implement international financial reporting standard as a basis for financial reporting. This is some issues we would like to discuss today. The first one is we try to understand some concept of value in accounting measurement because we have entry value, also exit value. We also have value in use and value in exchange and fair value and fair market value. And then we try to move to other issues, that is a factor that should be considered in determining fair value measurement. And then the last one is three approach commonly adopted in measuring fair value. To start our discussion, let's say this simple case. Assume that at a Christie's art auction, the last two buyers are competing for Rembrandt's a picture with the bid going up in increments of $1 million. So at $20 million, one buyer or one bidder drop out, and then the remaining bidder wins the picture at $30 million. So based on this simple case, the question is which one represent fair value and which one represent fair market value. So before we move to the slide, just think uh, about this simple case. Try to identify which one represent fair value, whether 29 million or 30 million dollars, and which one also represent fair market value. Okay, we'll discuss later about the case, but before we discuss more about the case, let us try to understand some concept in accounting, especially in the measurement asset or liabilities. So we have different value perspective. The first one is entry value and exit value, and the second one is value in use and value in exchange. When we talk about entry value, or commonly called as value measurement basis, is actually a value that indicate the price currently paid for the purchase of an assets or settlement of liabilities under orderly conditions. So in other words, entry value represent the market buying price. So what is the price we will pay if we purchase a certain asset? This is what we call as entry value. Those in terms of accounting measurement, entry value can be used as initial measurement, that is at the time of transactions, in which we may use historical costs, and then at the subsequent measurement, or in this case, on the date of reporting, 30 December every year, we may use replacement costs to measure our asset. So replacement cost is the amount of money required to replace an asset with a new or similar ones. So this replacement cost actually reflect the current market price of an asset, not the original or the historical cost. But this is the estimated cost, but the cost or but the price that we have to uh, issue or to pay to replace our asset with a new or similar one. So again, in using this value, the entry value, we can use historical cost at the time of initial measurement, that is in the time of transaction, and then when we report a similar asset on the date of reporting, or we call as subsequent measurement, we may use replacement cost. The next concept of value in accounting is exit value. And then when we talk about exit value is actually the estimated price which will be received for the sale of an asset or transfer of a liability on the open market. So this entry value usually adapted for accounting purposes and might be also used in a variety of ways. And exit value is also used as the determination of fair value for the asset. So in simple word, exit value can be seen as market selling price of any item. So in terms of measurement, exit value may be used as a measurement basis for subsequent measurement by using net realizable value, that is estimated selling price deducted by its relevant cost. And then for remeasurement, we might adopt fair value as basis for the measurement. And based on these two definitions, we can see here that entry and exit value are actually market value, talking about estimated prices. Meanwhile, entry value is concerned with the estimated price when we buy something, and exit value is the estimated price when we sell something, we sell our asset. Okay, the second concept is value in use and value in exchange. So value in use is actually the value of asset that is used together as unity. So we do not use the asset as individual one, but we try to value the asset when we use the asset together as a unity. For example, when we value desktop computer, we might have monitor, and then we might have CPU, keyboard, and also mouse. And each item here, CPU, has its own price. For example, in this case, individually CPU, the price of CPU is 10 million, and then monitor 2 million, keyboard assume it is 1 million, and then the mouse 500,000, and then the total price for all this item individually, when we total all in aggregate, we get 13 million 500,000. Okay, and then when we measure this asset as unity, when we use together, the price of the asset, the desktop computer, might be 13 million or maybe 14 million, not 13.5 million. So this is how we value asset in use, in which the asset is used together as unity. Meanwhile, value in exchange is value when asset will be sold principally on a standalone basis. So we can sell this asset individually without using any other assets. For example, we might have marketable securities. In this case, assume that PT Mulia has the following asset: investment in Aneka Tambang stock at the amount of 900 million, and then it also has investment in Nestle stock with the amount of 500 million. So if we want to sell the asset individually, so we can sell it individually. That's why we can value this asset based on individual one, not asset as unity. But they can we can sell this asset as a standalone basis. We can sell investment in Aneka Tambang, and then we might sell investment in Nestle stock based on the market value we have. So this is how we differentiate value in use and value in exchange. Now it's time to talk about the fair value and fair market value. Again, even though this two concept of value has a similar name, the first one is fair value and the second one is fair market value, but actually the both are different. In this case, fair value is seen as the premise is solely from the viewpoint of the seller or a buyer. So the estimated price we set is based on one party perspectives, either buyer or sellers. So not from both perspective. So fair value again is estimated value. For example, what it would receive to what price we will receive if we sell something, we sell our assets. Meanwhile, fair market value is the premise or the price that is determined by two parties, that is a willing buyer and willing seller. So the both parties are agree to certain prices. So the both agreement on the price is deal with fair market value. So the price agreed by both parties are set as fair market value. So fair market value takes both perspective in measuring any asset involving willing buyer and willing sellers. Okay, back to the case, the previous case I discussed before. Assume that at Christie's art auction, the last two buyers are competing for the brand picture with bids going up in the increment of $1 million, and then at $20 million, one buyer, one bidder drops out, and then the remaining bidder wins the picture at $30 million. So based on this case, we can see here that the fair market value in this case is actually $30 million. Why $30 million? Because this price is the price that is agreed by two parties. That is willing buyer, the successful bidder, and the willing seller or the consignee. So both parties agree with the prices. That's why the fair market value is $30 million. Meanwhile, from the perspective of fair value, we can see here in this case, the fair value is $20 million because at this price, the buyer believes that the price is of the picture is $20 million dollars. Beside this price, then he cannot afford to buy the asset. So in this case, fair value is estimated a price seen by one parties, that is the unwilling buyer that can pay 30 million because he believes that the pictures is actually the value of the picture is actually $29 million. So based on the previous example, the next question is, what is actually a fair value? So if we refer to the accounting standard, yes, 13, fair value concept is actually estimated price based on exit price. So fair value is the price that will be received to sell an asset or will be paid to transfer a liability in an orderly transactions between market participant and then at the measurement date. So we need to understand what is orderly transaction, what is market participant, and so on. So this is what we call as fair value, the price that will be received to sell any asset and will be paid to transfer liability in orderly transactions between market participants and the measurement date. So in defining a fair value, we have the concept of orderly transactions. So what is orderly transactions? An orderly transaction is a transaction that assume the exposure to the market for a period prior to the measurement date to allow for marketing activities that are usual and customary for transaction involving such asset or liabilities. So in this case, the transaction is not a forced transaction. This is a normal transaction, usual transactions involving any parties who want to deal with some buying and selling in the certain market. So there is no forced transaction when we use fair value measurement. An example of forced transaction is forced liquidation or distress sale. The second factor in defining fair value is market participants. In this case, we assume that in setting fair value measurement, we assume that the market participants are independent. So both seller and buyer are independent parties. They are not related parties. They have no special relationship and so on. And the second one, market participant should also be knowledgeable, due diligent. They know well about the product, the specification of the product, able to estimate the price and so on. So this is what we call as knowledgeable. And then the buyer and the sellers are able to transact for the asset and liabilities. So they might offer certain price and so on between buyer and the seller. And then the buyer and the sellers have a willing to transact for any asset and or liability. So this is not a forced transaction. They have a willing, they have a intention to offer their product, and then the buyer also need have a willing to buy the product based on their knowledge about the product, and then they are not the related parties. So when we talk about orderly transaction, especially at the time of measurement, so we assume that an orderly transaction exists in the principal markets or in the most advantageous markets. So we need to consider these two type of market before deciding uh, what price in the market should be used in determining fair value. So the first one, consider first, is there any principal markets? And then, is there any most advantageous markets? So what is principal market? Principal market is a market which provide us with the greatest volume or the level of activities. Or in other words, principal market is any market that maximize the amount that will be received if we sell our asset, considering our transaction costs related to the asset. So this is what we call as principal market, the greatest market that provide us with the greatest volume of transaction, that able to maximize the amount that will be received if we sell our asset in the markets. So if we find that there is a principal market, then use the price in the principal market as fair value. So the fair value is equal to the price in the principal market when we know that there is a principal market. However, if we find that there is no principal market, if there is no principal market, then we should use the most advantageous market. So what is most advantageous market? The most advantageous market is a market that maximizes the amount to sell our asset, or the market that minimizes the amounts to transfer our liability, considering any transaction costs and transport costs related to the asset or to the liabilities. So this is what we call as most advantageous market. Any market that maximizes the amount to sell if we want to sell our asset, or minimize the amount to transfer our liabilities when we want to pay our liabilities, considering the transaction costs and transport costs related to the asset. I give you a simple example here how we use a price in market, the principal market or most advantageous markets. Let's say that there is financial assets which is traded on the two different market with different prices. In market A, the price is $26 and the transaction cost is $3. And then the net amount in the market, in this market, market A, equal to $23. So 26 deducted by 3. And then on the other side, in market B, the price is $25 and the transaction cost is $1. So the net amount in market B is $24. So the question is, what price should be used as a fair value if we refer to this simple case? Just think about what price should be used, whether 26 in market A or 25 in market B. To answer the question which price should be used as fair value, we have to make sure whether there is principal market or not in the both market. If we believe that market A is the principal market for the asset, then the fair value is based on the price of asset in market A. In this case, we should use $26 as a fair value. That is the price in the principal market. So this is assumption when we believe that market A is the principal market. Meanwhile, if we believe that there is no principal market, then the fair value should be the price in the most advantageous markets. So which market maximize our value when we sell our asset? In this case, we can see here that market A, the price of selling asset is 26, and then we deducted the price with the cost. We got net amount equal to $23. Meanwhile, in market B, the price is $25 and then the cost is $1. Then we got net amount of $24. So if we compare the net amount of the two market, we can see here that market B, the net amount is 24. So the market B is the market that maximize the price we would receive when we sell our asset. So consequently, the fair value of the asset is the price in market B. In this case, we have $25 here. Okay, the reason is simple. The price in the market B is the price that maximize the net amount when we sell the asset. That is 24. So the price we can use as fair value is 25. That is the price in market B. Okay, then to calculate the fair value or to set the fair value of certain asset or liabilities, we need some step. The first one, we have to we have to able to identify the particular item to be measured, what we call as unit of account, considering location, condition, and any restriction that go with the asset. And then the second step, just determines the particular asset, the highest and best use and the valuation premise. So we need to consider value and use and value and exchange, or asset and use and asset and exchange. And then the third one, try to identify the information available for fair value. We need to consider the input of the information and the level of hierarchy of the information. And then we might adopt a valuation technique, whether we might use market technique, market valuation technique, cost valuation technique, or income valuation technique. And then the last one, we need to disclose the adoption of certain prices basis for fair value measurement. Okay, the first step in measuring fair value is the need to understand what we call as unit of account. So unit of account is actually what is being measured, talking about the level of asset we sell, whether the asset is aggregated or asset in use or disaggregated, or in this type of asset is asset in exchange. And then second one, we need to estimate the highest and the best use of the asset by market participants. It's depend on whether physically possible to use the asset, and then legally permissible if we want to sell the asset, and financially feasible at the measurement date. So this is a three aspect we need to consider when we want to measure the unit of account, whether we need to measure asset or similar one. Okay, dealing with asset in use, which one we should use, asset in use or asset in exchange. So in terms of asset in use, the highest and the best use of the asset is in use if the asset will provide maximum value to a market participant, principally through its use in combination with other asset as a group. So this is usually applicable to non-financial asset like land and building, computer desktop, and alike. So the fair value of the asset is the price that will be received in the current transaction to sell the asset, assuming that the asset will be used with the other asset as a group and then will be available to the market participant. So this is what we call as asset in use. So we use together as a group, as a unity. So we can use individually, but we use as a group. That's why the fair value of the asset is the price that will be received in a current transaction to sell the asset, assuming that the asset will be used as with the other asset as group and will be available to the market participant. Meanwhile, for asset in exchange, the highest and the best use of the asset is in exchange if the asset would provide maximum value to the market, principally on a standalone basis. So this concept with individual asset. For example, we might measure financial asset like stock or share, and then in this case, asset and exchange, the fair value of the asset is the price that will be received in the current transaction to sell the asset standalone. So we might sell this asset individually in the current transactions that the asset would able to maximize the value to the market participant on a standalone basis. Then the second steps in measuring fair value is we need to understand the input and the level of measurement. So we got two concepts here. We got input and level or hierarchy. Input represent the assumption that market participant will use in pricing the asset or liabilities. Meanwhile, level or hierarchy concerned with the order of using input for fair value measurement. So we consider the most reliable source of information from a certain asset. So in terms of input, the assumption that market participant will use in pricing the asset or liabilities, we have two input. The first one is observable input, and the second one unobservable input. Observable input is any information that is based on independent market source. For example, information of price in the stock exchange. And then the second one, the unobservable input, is all informations concerning price that is based on the assumption on the reporting entity perspective. So we use the best information available at the time of measurement. So we just make some assumption, the best information available for the reporting entity in setting the price that will be received when we sell our asset or when we transfer our liability. So this is the concept of input and hierarchy in measuring fair value. So we need to consider what kind of input we have in measuring fair value measurement, whether it is observable input or unobservable input. So observable input deal with input or informations which based on independent market sources like prices in stock exchange, and then unobservable input concerned with any information of the prices which is based on reporting entity perspective, that is the best information available for the assets. In line with level of fair value hierarchy, we have three levels here: level 1, level 2, and level 3. Level 1 is based on the quoted price in active markets for identical asset or liabilities at the measurement date. And then level 2 is concerned with input other than quoted prices that are observable either directly or indirectly. And the last one, level 3, is fair value that is based on unobservable input based on the best information available in the circumstance or in the time of measurement. So we use this level in order. It means that when we are able to use level 1, then use prices in the level 1, that is quoted price in active market, as basis for setting the fair value. If there is no prices in level 1, then move to level 2. After that, we move to level 3. So this is the process of choosing the right prices based on the reliability of the information. So this should be put in order. Use the level 1 first, use the level 1 first, and then followed by level 2 and level 3. In terms of level 1 input, as I mentioned before, we base the prices on the quoted price because the quoted price is the most reliable sources of the fair value. So for example, we might adopt prices from Indonesia Stock Exchange, New York Stock Exchange, Nasdaq, and so on. So we use the price from the most reliable sources available at the time of measurement. So this is the most reliable measure and should be used whenever possible. Next, when we are not able to use level 1, then we should use level 2 as input of information. So we use prices based on observable input, that is based on quoted price for similar asset or liabilities in active markets. maybe use also quoted price for identical or similar asset in inactive markets. And we also may use input other than quoted price that are directly observable. And the last one, we may use input derived from observable market data by correlation or other measurement tools. So for example, uh, in US, they might use matic pricing for loans or debt instrument as basis for observable input, and then market correlated pricing, input such as yield curve, indices, and so on. An example how we may use information of this observable input as basis for setting the fair value. Next, when we are not able to use level 2, then we move to level 3 as input for our fair value measurement. So in this level, we use the prices in the market or prices for measurement of our fair value by using an observable input. So use in this term, we use the reporting entity on assumption based on the best available information we have. So we may also use other entity specific input, maybe historical or projected financial information that are not derived from the market data. So this is different from the two previous level 1 and level 2. Level 3 is actually based on assumption made by the entity, the reporting entity, because we have no information in the market. That's why we need certain assumption using the best available information of the asset we have. So if we put the fair value hierarchy in terms of a picture, we can see the picture here. So we have level 1, level 2, and level 3. Level 1 is based on quoted price of the share traded on the stock exchange, like Bursa Efek Indonesia Stock Exchange, Nasdaq, and etc. And then this is the most reliable information we can use to measure our fair value of our asset. And the second one, for level 2, we may use quoted price for similar asset in active markets. Maybe we use quoted price for similar or identical asset in inactive markets. And then we may also have use other observable input. And then we may use market correlated input. And then level 3, this is the non-market price. So we can use our best information we have by using financial forecast, historical volatility, and then make some adjustment to the mid-market consensus. So this is the fair value hierarchy when we want to measure fair value, and just consider which level we can adopt according to the asset, the type of asset we want to measure. So we can use level 1, level 2, and level 3. And then again, the most reliable basis is on level 1. Next, in fair value measurement, we may also adopt a valuation technique proposed by Statement of Financial Accounting Standard 157, in which we may use market approach, income approach, or cost approach. Market approach is fair value measurement that is based on the quoted price and other relevant information from market transactions involving identical or comparable assets. So this is similar to level 1. And then we may use a quoted price as fair value measurement for equities, and then bonds and direct investment in companies. So this is three example how we may use a quoted price in the markets as a basis for setting fair value. Second one, we might also use income approach. So in income approach, we use valuation technique to convert the future amount to a single present amounts using cash flow or certain earning. So we might use, in this case, we may use present value, option pricing, and multi-period excess earning. And then usually this approach can be adapted for real estate measurement, OTC option, and swaps. OTC option is over the counter option, or maybe uh, called as dealer option. That is an option that are traded between two private parties and are not listed on a certain stock exchange. The term of OTC option are unrestricted and may be individually tailored to meet any business needs. So meanwhile for swap is a derivative contract through which two parties exchange the cash flow or liabilities from two different financial instruments. And most swaps involve cash flows based on notional principal amount such as a loan or a bond, although the instrument can be almost anything. The last valuation approach is cost approach. In this approach, we set a fair value of the asset based on cost that reflect the amount that will currently be required to replace the service capacity of an asset. So this is usually called as replacement cost, the current replacement cost. However, it is important to note that replacement cost does not apply to financial asset and liabilities. So this is applicable for non-financial asset. In short, when we depict the valuation technique under Statement of Financial Accounting Standard 157 or IFRS 13, we can see here that the valuation techniques can be divided into three approaches: market approach, cost approach, and income approach. And then when you use market approach, we use market multipliers or market automatic pricing based on the information available in the market and active market. And then cost approach is applicable for non-financial assets using current cost replacement, including the consideration of obsolescence of the assets. And then for income approach, we may use present value technique, option pricing model, multi-period excess earning method, rally from royalty method, or with and without method. So you may, if you want to see detailed explanation of this approach, you might read Statement of Financial Accounting Standard. Okay, the next aspect that we need to consider when we measure fair value of asset or liabilities, we need some disclosure requirement. So fair value measurement need disclosure about each major category of asset and liabilities. We need to disclose the fair value measurement for each major category of asset and liabilities, and then the level within the fair value hierarchy each measurement falls, and the valuation technique adopted to measure fair value, and maybe a discussion of changes in valuation technique. So if we refer to how we disclose information about fair value measurement, we can see here. This is an example of fair value measurement disclosure. So we disclose the hierarchy level here. We got level 1, level 2, and level 3. And then the asset we involve here, we got common stock, investment investment entities, and then short-term fund, common collective trust fund, and so on. And then how we use quoted price for level 1, and then significant other observable input for level 2, and significant unobservable input in level 3. So in this disclosure, we need to include some information about what is being measured, what kind of asset that is measured, and then the value measurement hierarchy uh, based on level 1, level 2, and level 3. We may adopt according to the asset being measured. Other information that is required to disclose is disclosure about level 3. So in level 3, we need further information of disclosure, especially reconciliation of the beginning and ending balance, separately presenting changes during the period attributable to total gains or losses for the periods, whether realized and or unrealized, and then segregating those gains or losses, including in earning or changes in net asset. And then we also need to describe where those gain or losses included in earning or changes in net asset, which are reported in the statement of income or activities. And then we need also provide information about purchase, sales, issuance, and settlement in terms of net amount. And then transfer in, transfer out of level 3, for example, transfer due to changes in the observability of the significant input. So this is some information that we might need to disclose, especially all fair value measurement concerning the use of level 3. And this is an example of level 3 disclosure. So we need some reconciliation about the beginning, balance, and so on, total realized and realized gain and losses, including in changes in net asset, and then fair value measurement using significant observable input level 3 that concern with investment entities, common collective trust and fund, and so on. And then we also provide information about the ending balance, and then the amount of total gains or losses for the period, including in changes in net asset attributable to changes in unrealized gains or losses relating to asset still held at the reporting date. So this is just an example how we need to disclose some informations regarding the use of level 3. Why we need more disclosure about level 3? Because level 3 is setting fair value based on the best estimate of the reporting entity using the best information available at the time of measurement. That's why we need more information, we need more disclosure about the adoption of level 3 for certain asset. Okay, that is the technical aspect that we need to consider when we want to measure asset or liabilities using fair value. Next one, we might need to discuss why we should use fair value. Okay, we got some reasons why we need to use fair value. The first one is fair value might improve the transparency of information provided to the public trust. So when we got the relevant information, because we know that fair value is based on the most current value based on certain market. That's why fair value provide more relevant information compared to historical costs. And the second one, fair value information is vital in the time of economic stress, because in the economic stress, we need relevant information that enable user to make any certain economic decisions. And then where we need fair value, the third one, any suspension of fair value would weaken investor confidence and might create market instability. Because when we do not use fair value measurement at a certain condition, then the number we reported on financial statement might not reflect the actual condition of the asset or liability. That's why this information might decrease the investor confidence, and then there is possibility we find a market instability. Okay, the next slide, we will show you some example how accounting standard, international accounting standard adopt a fair value measurement. So we got IFRS 2, 3, 5, 7, and then here starting from share-based payment, then business combination, non-current asset held for sale, and discontinued operations. And then we got financial instrument disclosure, and then financial instrument. Next one, fair value measurement also adopted for IS 17 leases, and then employee benefit, government grants, accounting and reporting by retirement benefit plans, and investment in associate. Then fair value measurement also adopted for the international standard like impairment of asset, and then financial instrument recognition and measurement. Even though this standard has been amended with the other new standard, but again the adoption of fair value measurement still exists in the standard. And then we may use fair value measurement for biological asset, and then service concession arrangement, and customer loyalty program. Next, fair value measurement also adopted as FS1, the first time adoption of IFRS, and then property, plant, and equipment, consolidated and spirit, a financial statement, intangible asset, and investment property. So this is some examples how fair value measurements has been used as a measurement basis or valuation basis for certain item of financial statement, as stated in uh, a lot of international financial reporting standard. Finally, when we talk about fair value measurement, so again, don't forget to understand the concept of value in accounting. In accounting measurement, we need to understand about entry value and exit value. Both are market value, and exit value are the value we use for fair value measurement. And then we also have value in use and value in exchange. This is also uh, required in measuring fair value for certain asset. And then we have to consider the differences between fair value and fair market value. And then if we want to measure asset or liabilities using fair value, then we need to consider some factor like unit of account, and then input, level of hierarchy, and also a valuation technique that are required to uh, measure the fair value of certain item. And then don't forget to consider three approach in fair value measurement, starting from markets and then cost and incomes. So this is some issues that we need to understand when we talk about fair value measurement. Okay, if you have any comment or any questions, just put your question on the comment below. Okay, thank you for joining this class. See you next week. Bye bye.